We've got a great conversation lined up for you. In fact, I'm going to hand it over to my colleague and markets editor, Neeraj Shah, who's going to be in conversation. Neeraj, with Sonal Varma. I'm glad that this is happening and I'm looking forward to this conversation.
Yep, I'm looking forward to this too ever since I read that note, Alex, though not for the right reasons, because the note suggests that the growth class of India looks half empty as per their 3 proprietary indices. And therefore, it's an absolute delight to have in Sonal Varma to try and understand what is it that they feel about the growth aspect, because a lot of FMCG firms and some others are already showing some chinks in the armor. Sonal, great having you. Thanks so much for joining in. And at the onset, I want to start off with something that you wrote at the start of the note, which is that high frequency growth indicators, according to you, were anyway signaling a slowdown since June. But now you're finding other proprietary indices talking about the same being more pronounced.
Yeah, Neeraj, thanks for having me. So actually, the idea here is to do a more objective analysis of what's going on in growth. So this is not about what we think. It's about what actually the data are telling us. So we've used a combination of high-frequency real activity data covering consumption, investment, and exports, and brought it together into one aggregate index, which we call the Nomura India Coincident Activity Index. And what that is telling us is that on aggregate, there has been a sequential decline in underlying growth momentum. So even on a seasonally adjusted basis, the September quarter is quite soft. And two, on a year-over-year basis, the Nomura India Coincident Activity Index, which tends to track the broader GDP growth cycles pretty well, it is suggesting that the second quarter is likely to be slower than the first quarter. So as you recall, the first quarter, we had already seen GDP growth moderate to around 6.7%. So this is suggesting that growth is likely to moderate to potentially below 6.5% in the second quarter. And third, we also look at what's driving this. And what we find is that it's largely investment and industrial activity indicators that have seen a sharp slowdown. But in addition, some of the consumer discretionary sectors is also where we are seeing a moderation. So this is actually just based on the numbers that we have so far that are suggesting that when the GDP numbers are released for the second quarter in end November, it's likely to be much weaker than what RBI is expecting, which is at 7%.
Sonal, how big a concern is this? Because typically growth doesn't flip and flop. It tends to at times pick up a trend, right? So do you believe this is a trending lower kind of a trajectory we are in? Or can a pickup in government spending or maybe private capex really thwart this downtrend, if you will?
Which is exactly the question we are asking ourselves. And what we've also constructed is actually a leading index for India's non-agriculture GDP growth cycles. And it has a lead of 1 quarter, so it gives us an insight into the third quarter of the financial year. And we see that the leading index has actually been moderating for the last 3 quarters. And the signal from the leading index is that the December quarter is also likely to be softer. We also see that our leading index, has moderated below the 100 threshold, which typically tends to be growth around trend. So the momentum is weakening, and we seem to be transitioning to below trend growth in the third quarter. And as you said, typically the growth cycles tend to have some lasting character. Like usually growth cycles last at least 4 quarters, and that to us is a signal that India is potentially entering a cyclical growth slowdown. I say cyclical because it's not a view on where India's medium-term growth is going to be. It's more about what the direction is of the business cycle in the next 12 months. And at this stage, the lead indicators are suggesting that it is going to moderate. Now, there will be certain components of growth that will pick up. For instance, like government spending is going to pick up, given it was quite soft in the first half of the financial year. But on aggregate, the signals are that there is likely to be a growth cycle moderation going forward.
Sonal, idiosyncratic factors you think, and now I'm telling you to move out from the realms of data that you have and put in your thinking hat. Idiosyncratic factors, inward-looking factors to India, or is this got largely to also do with the way the growth around the world or the lack of it is shaping up?
Yeah, I don't think this is globally driven. I mean, the export and related indicators have definitely been soft. But most of the moderation we see is more domestic demand driven indicators. So it is investment and discretionary consumption driven. I think when you look at the first half of the year, clearly there have been certain idiosyncratic factors that have been responsible for the moderation. Whether it is the elections and the slowdown in construction activity, or the heavy monsoons and the adverse impact of that, or the timing of different, calendar and impact on spending. And some of those things will reverse. So government spending is going to pick up, and we should see rural hold up. But there are other countervailing factors that are at play. So for one, on the credit side, we are continuing to see a moderation in credit growth, particularly consumer credit growth. And this is what policy wants. But on the other side of who's taking credit is a consumer, who will face constraint in terms of discretionary activity going forward. So we see moderation in credit growth as suggesting that there will be some impact on consumer activity going forward. And similarly, on the the urban demand side, we are seeing a moderation in salary growth. It was growing above 10%. That has moderated to around 5%. So the real income increase is actually much slower. Third, I think within the rural, we have seen a pickup, but there's some sort of a friction on food prices, and to some extent, certain elevated food prices, which we don't think is actually a major problem from a medium-term perspective, but it is hitting some of the urban low-income consumers. But also you have 50% or more than 40% of employment in India is still agriculture-driven. So when we try to squeeze out broader food inflation, it also has some adverse impact on food producers. So this balance between a food consumer and food producer, the friction is something that we are beginning to see. And finally, I think given the current picture on consumer as well as on where currently we are on the export cycle, I think this entire debate about whether private capex is picking up, whether it is broadening out. I think in the current environment where global and domestic demand picture is soft, it is quite unlikely that private capex is going to pick up. So I think when we're thinking about the broader outlook for growth, there are components that will do better. But on aggregate, we do think there are countervailing forces, which is why we don't think it is just idiosyncratic factors that led to the moderation. There is an underlying cycle moderation that is underway as we speak.
Sonal, some bit of corporate commentary thus far has also indicated that, but of so many consumption firms that we've heard, and we've thus far heard from consumption companies largely, the capex-oriented firms yet to come, but the consumption-oriented firms have spoken about longer election season and extended monsoon being the reasons, and they are hopeful of recovery in the second half. So my question to you is, if there is a natural bit of a recovery that comes in from a base that is impacted because of unnatural quarters, if you will, and if there is, say, a bit of an overdrive in government capex, which has been subdued thus far in the first half, can that quell the downtick, even if it doesn't result in a big uptick, but can that kind of help cushion the downward trajectory? Because I heard you say that December also looks like it will be a soft quarter. Can both of these factors help the fall to be not so dramatic?
Yeah, I think we should see some positive offsets going forward. So one, of course, let's see how the festive season demand goes and to what extent the discounts do help boost consumer activity. So that's something we are monitoring as well. And second, we do think that government capex will see a faster pickup going forward. So that should be a driver of demand. And third, rural-related components. I mean, there are positives and negatives, but to the extent that production is better, you should see that do relatively fine, I would say. So those positive offsets are there. I think, if you look at what the RBI is projecting, their overall GDP growth projection for FY25, though, is at 7.2. And second half FY25 growth projections are closer to 7.4%. So the assumption is that we basically move up from 6.7 to 7 in Q2 and then closer to 7.5 in the second half of the financial year. What I'm saying is that the positive offsets that will be there in the next 6 months are playing against some of the softness we are seeing in terms of high interest rates, moderating credit growth, and still subdued global demand and exports in particular. So on net, we think it is quite unlikely that GDP growth is going to exceed 7% in Q2 or in Q3 or in the fourth quarter of the financial year. So we are basically projecting FY25 GDP growth at around 6.7%. And we're monitoring this. I mean, I think, the early signals, I would say, are flashing amber. Now, whether this has more legs or something changes is something we need to monitor. But the signals at this stage are flashing amber on the growth side, which makes us a bit cautious.
Yep, thanks for the warning sign as well. Sonal, lovely note, and thanks for joining in today and giving us your perspective, and festive greetings to you and everybody in your team and family.